Good afternoon, everyone. My name is Lisa Pendergast. I'm the Executive Director of CREFC. Before we get started, I want to thank Dr. Shandon and all the wonderful folks at Schack for their invitation to participate in the conference that so many really hold in high esteem, so we're very grateful. All of us at CREFC are looking forward to working with Sam and his team in developing further the CREFC Center for Real Estate Finance at the Schack Institute. Our goal really is to share with everyone today the current state of the CRE lending markets as it pertains to our panel. And to do that, we thought it would be best to bring all lending perspectives into the discussion. So today, we're going to introduce life company perspectives, banks, CMBS, debt funds, and multifamily lenders. So I'm going to ask each of the panelists if they would introduce themselves at this point, and then highlight your role in the industry, and then we'll get started. Want to start with Matt?
Sure. I'm Matt Cohen. I work at Mesa West Capital. We are a debt fund, and my role there is I manage our capital markets activity, which includes, as a debt fund, every loan we make, there is a portion of the loan that we end up not owning, and that all gets incorporated under the capital markets department.
Great. Rick?
Sure. My name is Rick Simpson. I'm the head of securitization in Citi's CMBS and real estate finance group. Last year we were the top contributor of CMBS mortgage loans to CMBS transactions at about $11.5 billion. And this year we're expected to be, while not expected to have that much origination in issuance, we're expected to be close to the top as well.
Fantastic. Bryan?
Hey, Bryan McDonnell. I'm the head of real estate finance globally for PGIM Real Estate. So we are a large investment management shop. We have a series of debt funds we manage, a large agency business. We lend on behalf of and the like. So playing around a little bit in everything, operate in the US, Europe, and Asia Pacific.
Fantastic. Greg?
Hi, good afternoon. Greg Michaud. I'm the head of real estate for Voya. Formerly ING, run anything involved with real estate. So commercial mortgages, we have a debt fund. We have a pretty active third-party business with representing about 23 life insurance companies, and also help out with CMBS, public bonds, anything related to real estate.
Fantastic. Thanks, guys. Jenney, are you with us? Okay, I think Jenney will join us hopefully shortly. So I'm going to start off with some questions. All of these are jump balls, so please, jump, answer. Otherwise, I'll have to call on someone. Don't want to do that if I don't have to. So I've kind of broken down these questions into subcategories. And the first category that I have is aptly entitled, "Are you all open for business?" The CREFC's Board of Governors Sentiment Index highlighted recently for the third quarter, when they were asked whether their lending programs were fully operational, 64% said yes in October. Doesn't sound like a great number, except when they were asked the same question in April, it was 21%. So we're seeing an uptick. And don't forget that these are lenders across the platforms. It's, all of the folks represented here are also represented on our board. So could you provide me some color on the level of your origination? What does it look like today relative to, say, pre-pandemic, March, April period, and then currently? And then what's the composition of those loans? Are they refis? Are they new originations, et cetera? So jump ball, whoever wants to kick off.
Sure. Well, I started the first round. I'll start this round. We are open for business. We have Mesa West. We are currently investing on behalf of two different debt fund strategies. One of them is closed end, one of them is open end. We are looking for opportunities for both funds. Have found, frankly, that there's not a ton of, it's obviously not a ton of acquisition activity for the first half of the year, really for the last 6 to 7 months. So there's been a little bit of a dearth of opportunities. We have closed a handful of loans post-COVID, all of which were new originations. But we are way off what our volumes would have looked like in 2019.
Great. Okay. Rick, do you want to talk about that?
Yeah, sure. I can jump in. I mean, private label CMBS transactions, both conduit and SASB, are down, roughly 35 to 40% this year. As I mentioned before, we contributed about $11.5 billion in CMBS loans into transactions last year. I would say we're probably going to finish around $8 billion, so 30% down. And the CMBS market, came to kind of a grinding halt after when the shutdowns occurred in March. But we had a very good first quarter. We were up, year over year versus last year in 2019. And 2019 was a record year for CMBS post Great Financial Crisis. So CMBS issuance basically stopped for about 2 months. We did our first post-COVID transaction in May, and CMBS lending didn't pick up for roughly 4 months. We started doing new originations, post-COVID originations in, call it July, August, and September. And then, we've really picked up the pace. But the question is, new opportunities, with the turmoil in hospitality and retail space, it removes a large chunk of financing opportunities for us to do. But I will say one thing that's helped us is I think there's just less competition from CMBS lenders. That is, there's plenty of competition out there. The big banks with established shelves that can go to market when they're ready, I think have an advantage over smaller non-bank CMBS lenders that rely on the big banks for distribution purposes. So again, the question I think for us is supply and opportunities going forward. And when retail and hotel properties represented 30 to 40% of a CMBS transaction pre-COVID, there's just far less opportunities for us, going forward until those markets come back, those property types come back.
Great. No, thank you very much. Bryan?
Sure. I'll jump in here. It's been, I was actually just pulling it up here. We're at 15.1 billion closed year to date, which is almost exactly where we were last year, which is a fascinating overall statement. But anytime you take summaries, it hides the real story. You can do anything with statistics, they say. And so I think when you look at it, similar to Matt, if you look at our debt funds, they're off. I think they're more transitional in nature, and trying to underwrite transitional plans on offices or whatever you have it today, it's trickier. Not to mention, certain of our funds have higher return targets, and as the treasuries have dropped so precipitously, and some of the banks came out on the loan financing, it affected a little bit of how we approached it. So our debt fund business is probably going to be half of what it was last year in terms of production. Our life company like lending is probably going to be off maybe 10-15% overall from where it was, but we're seeing that being made up by a massive move to the agencies. And so a lot of our agency lending, Fannie, Freddie, FHA, are all having, for us, record years. And it's pretty much a flat business there in terms of Fannie and Freddie managing to caps. But the way it's played has played well for us. And then some of the more shorter term bank type capital we've financed quite a bit there. I think though the theme throughout it though is the challenge in the industry right now, for the most part, and Rick touched on this, a lot of our investors and almost everyone in the industry now is over focused on multifamily and industrial. There's almost like all the other asset classes just disappeared. Trying to get someone to talk to retail is some of our investors, they don't want to talk about it. They don't talk about it at all. And so that's really going forward. I think the question to the industry is how we're going to put money out, how we're going to do investments, unless you start unlocking some of these other asset classes. I'm not as worried about some of them, but in terms of the investor perception around it, I think there is something that we're going to have to manage there. So that is certainly. And I think the other question for the industry is how much of this business have we pulled forward to this year? Rates dropped enormously in terms of treasuries. So that did pull forward some 2021, 2022 business into this year. And does that have a knock-on effect in future years?
Yeah, no, that's a great point. Greg, do you want to add to?
Yeah.
To the-
Yeah, sure. I think most insurance companies stayed in the market, and really most of because we have different buckets of money, much like everybody else here. So we've got a debt fund that was very active during this time period. And we had a couple of insurance company clients, pull out, but for the most part, most saw the opportunity in there. And we were able to get a fair amount of business that was kind of left at the altar by either CMBS or one of the CLO securitized lenders. They couldn't close for obvious because of the disruption in the market. And so we're able to grab some really really good deals, low leverage, high coupon deals that we're able to put in the debt fund and with our clients. So we just never got out of the market. The big issue, and it was hit on here a couple times. One, investment sales are way down, so that really has a follow-on impact to the debt markets. And two, everybody wants multifamily, everybody wants industrial. Nobody wanted anything else. And so that obviously restricts things. Everybody's chasing the same deals. We haven't seen a lot of good relative value in the core side, meaning the typical 10-year fixed rate life insurance company deals. We're seeing more value in the like transitional side of things. And so we think the relative value there is actually good if you can find it. But we have seen an uptick. We had a great first quarter, like probably everybody else. And then, the second and the third quarters are just kind of throwaway. So we're just seeing our production chopped down by about 40% when it's all said and done. Now we're seeing a lot of people flood in wanting loan closings for the end of the year, which also brings up the other point. Hey, is this pulling from next year into this year? But we're getting a massive amount of people that are like, look, if you can close this year, we'd love to do we want to get this deal done. So we've seen a very big uptick. And then the other interesting thing we've seen actual deal volume, i.e. the number of deals stay relatively constant, but the average deal size has really dropped. Our average deal size has dropped by half. And we sit down and talk to a lot of our brokers. One of our big brokers, JLL, they shared with us their average deal size. Their average deal sizes are down. So for some odd reason, the bigger deals just kind of disappeared. We're kind of seeing them come back now, but it was just a lot of small deals, which, it's tough to get a lot of money out when you're hitting singles.
So
doesn't that make sense though, Greg, in terms of, the larger deals are office, right? And so the office markets have been somewhat shut down.
Yep. Yeah, even big portfolio. We're big portfolio lenders where we do big portfolio deals. Just didn't even see a lot of big portfolios. I just think it was a lot of price discovery, and nobody wanted to go way out there on the limb to go buy something big, I guess.
I think, thanks everyone. When I think about what it is that you do, LTV, key metric, but the V part of this seems like a real lift in terms of determining value today, how long value will stay where it is, how much of an impact does, say, Monday's vaccine sort of information and news flow, well, how does that impact what you're thinking about value? And I'm going to do this sort of writ large value. We can talk specific asset classes, but just generically, amidst a pandemic, how do you find and how do you determine value? Anybody?
Yeah, I was going to say, the biggest thing. Oh, go ahead.
Go for it, Greg.
Yeah, I was going to say CMBX really rallied, right, Lisa? I mean, you've seen that that better than anybody else. And it was almost like all of a sudden everything just was okay with that announcement. Now, then all of a sudden we get the follow-on talk about further lockdowns. But, valuation, we haven't seen cap rates move much. Maybe they even come down. It's really the manipulation of cash flow that we're doing right now. Just what if scenarios, if this happens, so we're doing more stress tests than actual valuations. But one thing that we've noticed a little bit is in the equities, when we get an appraisal for some sort of equity type transactions that we're looking at, those appraisals are higher than the debt appraisals we're getting. I'll leave you guys to figure out why that is, but it's just kind of, even the appraisers have no idea where value is.
Yeah. Yeah. I guess I was going to jump in and say, for us, while no one is ignoring the V, I think we're much more focused on cash flow today in terms of, we feel like there's noise in the valuations. I think you're waiting for a lot of these open-end core funds to get their mark to markets coming in the next year. And so little is traded that you don't know what's real that's out there outside multifamily and industrial. So the question is, could you see a big change in some of the V's and the other asset classes once you start seeing, some things trade into the next year? But I think for us, it's much more cash flow game. How stressed are the cash flows going to get, and trying to figure out for us, how does that buy you time? So you feel like if you've got a well underwritten deal, diversified cash flow, and you can bridge yourself for the next 2 or 3 years, we feel okay. Those that have really cash flow issues that are going to come in the next 24 months, big rollovers or what have you, that starts getting more difficult.
Right.
What's interesting on the cash flow front is I've spoken to a number of our competitors / colleagues in the space who have talked about hotels specifically having hotels that were early in their renovation business plan and feeling like it was the best timing ever for COVID because they had the structure, they had the future funding dollars in their loan to allow to get through this period without having the stress. So, but I agree with you in general. It's you just want to see that you have, I guess I would take one slightly different view is it's not just cash flow at the asset level. It's a deep pocketed sponsor who believes in their basis enough to want to carry it through to whatever the other side holds.
Yeah, no, I think you're seeing that in retail right now, which is some of the sponsors are like, look, could I make money out of this? Yeah, but it's in 2035. Do I really want to hang out that long and so that is part of it as well. Absolutely.
Yeah. And I'd say to your point, Matt, on the hotels, the light transitional hotels are going through the developers are like, look, we can empty this thing out now, fix it up. It's the low leverage, stabilized hotels that we're seeing more issues with right now because that's where it is. So that's a great point that you made.
Yeah.
So one other thing just on the values, Lisa, that to me, our average loan size last year was about $75 million. So no surprise that we have a lot of office. And so it's not only about determining what you think cap rates are going to be or what the right basis is, but really just having any kind of conviction as to where rents are going to be signed, where the demand is going to come from. You can talk to 10 different experts. They'll give you different opinions on the impact of COVID and the need for more space, the need, the co-working, whatever it is. But just until you start seeing real leases get signed and have a sense for kind of resetting of rates, and then kind of you can play that out and figure out where occupancies may end up. It's just really hard to have any conviction on how you apply a cap rate to, a very unstable number or unpredictable number.
Right.
Well, and then you further go a little bit of the argument that goes both ways. To make no conclusion here, but to play both sides of the argument is premiums over the risk-free terms, NCREIF cap rates are really as high as they've ever have been. And so that would imply, if you look at a European portfolio or specifically look at a Japanese portfolio, there's a whole argument the cap rates should be tightening from an average of a 5 to a 3.5, And so you make the argument that that's a big change in value, but then you also overlay, some of the challenges, some of the state governments, cities, and the financial challenges they have. Does the indebtedness of certain places offset that because you're going to need to see higher growth to get out of it? And so, I think you can make an argument around either side of that equation, but that's part of the other question is where will the industry go and how long are we going to keep this healthy premium or the risk-free?
Got it. Somebody mentioned it earlier. Loan terms. What are some of the core differences today than pre-COVID? And I think this is really applicable to all of you. And Rick, I don't know if you want to chat about that or anybody else wants to kick in, but what are some of the things you're doing to protect that you didn't do before? How is that going over? Just general structure, reserves, that kind of thing.
Sure. On new originations, we're looking at, I like to look at what we would have done pre-COVID and what we're contemplating doing now. And, for all intents and purposes, it should be more conservative than where we were before, given where we are in the pandemic. It varies property type by property type. We're probably willing to go higher leverage on a multifamily with little collections issues. But I would say generally speaking, we're trying to structure loans with better reserves for rollover if it's an office property. If there are collections issues, if there's major collection issues, we're not doing a loan. But if there's some collections issues, we're probably doing a debt service reserve, something like that, just to allow the borrower, to basically allow things that if they get better, if the vaccine is widely distributed and things get better next year, there's just a little bit of some structure there to sort of get us through the tough times. But I would just say, generally speaking, our loans are a little bit lower leverage on the margins, a little less IO, better structured, and as they should be, because it's definitely a different time than it was 8 months ago, 10 months ago.
Sure. Any other thoughts?
Yeah, I was going to say we're looking at. Oh, go ahead, bro. Go ahead.
Yeah, I'll jump in quickly just to maybe cover our agency. We haven't talked a lot about that.
If you would, yeah.
And they've been a little bit more programmatic in the approach, specifically on the higher leverage loans. So within Fannie Mae, if you get to a tier 2, 75% LTV, almost programmatically, you need to fund in cash 12 months of principal, interest, and taxes and insurance. So they're driving a hard line. And that's a substantial drag to your quote. It's probably 10% drag to your coupon. Now, the rate is so far and above anywhere else that you can take that drag. And so, but from a lender standpoint where I have risk in Fannie, we take a loss share, having an entire year of no cash flow to be able to bridge ourselves, again, gives us that comfort that we don't know what the future will hold. But with rates as low as they are, that can get us through a lot of bumpy periods into a better day. Freddie is not as programmatic. They'll look at the sponsor, but still they will also have a 6-month insurance escrow. Sorry, a 6-month P&I escrow as well. But given that in an average year, Fannie and Freddie finance 50% of multifamily, and this year, don't quote me, but they may end up like 75%. They're going to end up higher. I don't know what it'll be. They carry big weight in the industry. So a lot of other lenders can take a lead from them and say, well, I won't have quite as much structure, but I'll take a little bit. And so that has been helpful in this period of time to continue as some of these collections in San Francisco or New York are falling month over month, that it gives you a little bit more comfort that if it continues to fall, you've got some room.
That explains. I mean, I saw the numbers too recently on the GSEs. They're up pretty significantly, and you're telling me though that that's happening despite some of the significantly increased structure and reserves and the like.
Yep.
Okay.
At first, it was people were saying no way, and then they said, well, if I do the blended cost of capital, it's still pretty good, even if I'm getting a negative drag on it.
Right. Anybody else thoughts on multi?
Yeah, no, I was going to say, or no, on multi, it's.
Or anything, it doesn't matter.
Yeah, no, I was going to say, a little bit to what Rick was saying. This is just going to be incredibly idiosyncratic risk that you're going to have to figure out. We're looking at some deals, an office deal, and we got another office right next to it, and they're both medical. And our office deal just didn't have a lot of rent collections during COVID. And then we're looking at the new origination, and it had rent collections, and we're like, well, either the borrower is lying, or what did they have in their tenant mix that we didn't have in our tenant mix to why they saw rent collections. And so I just think it's just going to be incredibly idiosyncratic across asset classes, geographies, and that's what you're going to have to really parse out is how you want to structure your deals based on that risk that you're trying to underwrite around.
Okay. Any other thoughts? Otherwise, I'll move on.
I'll just quickly that you have a different view in terms of the protections you can get when it's an acquisition versus a refinance today. So I think most, if not all, the loans we've signed up post-COVID have been acquisitions, and we might want to put in some of the structure of, early in COVID, everyone was like, you're going to have an interest reserve no matter what. You're going to have a year's debt service covered. You're going to have X, Y, and Z. And then the reality of the matter is, when 5 years ago when Mesa West was one of 10 debt funds, maybe. Now when we're one of 300 debt funds, no. You figure out what structures are really necessary to feel good about the credit. But if you're at 60% loan to cost on an acquisition with a deep-pocketed sponsor, they're probably not walking away for the loan for less than 1% of interest costs that they have to carry over a 12-month period. So you'd like more than you're getting, but you just choose your battles.
And I think maybe one of the big surprises I have in terms of how this played out, I think this year's been probably an emotional roller coaster for everyone. I was in a dark place at the end of March, and in terms of thinking through it, I had 2 months where I feel like, and I'm guessing this group may be the same, where we feel like, we finally have some power in this conversation. We actually can demand some terms. And that went away almost overnight, and we're back into a borrower's market. It is competitive out there. It is very, very competitive. And so while deals are down, there's a lot of capital. and looking to deploy. And we're fighting tooth and nail for every deal.
I mean, is that capital coming mostly in the form, it's not distressed capital, it doesn't sound like it. And I do have a question on that later, but we can bring that up here. I mean, how much of that are you seeing already? Are you financing some of this, the distressed borrowers? I actually read somewhere that a lot of guys is, basically capitalizing on their existing assets, selling them off, reinvesting in distress. Are you seeing any of that?
We're seeing guys that, they raise a lot of money. They want to get a 15%, right? And so if they're looking, we've got a couple deals that, we might want to sell the note, and and it's probably worth par. But at 15%, they've got to get 95 cent number, and they want to get all the deferred interest that was there. So that's how they're generating the 15. I just don't see those guys that need the 15 if they're going to get it. I just don't see it out there. And I think what I'm seeing is a lot of the family offices that are like, look, I'll go buy these notes, and if I get a 6, that's great, because I'm kind of like an open-ended fund. I'll just redeploy it. But a closed-ended fund that's trying to do the capitalize on this market, they're holding out for 15, because if they go get a 5, they can't get it redeployed again. So I just think you had a lot of money get raised, just like, but to the other point that was made, it was a lender's market for about 30 days, and then the opportunity just went away. And I think those guys that raise that money raise it in that 30-day period too, I think. And I don't think they're going to find those 15s right now.
I don't know they'll find 15s, but I do feel like it's coming. And I think that you've got some of these asset classes that people are waiting for what the new normal is. And I think that's a big question out there in the market. We're holding on, but some of these jobs that were lost aren't going to come back overnight, even once there's a vaccine and even there. So I do feel like at some point you're going to get into some stress in certain areas. And at some point, sponsors are going to have to pick and choose which assets they got to save, because they can't go after everyone. They're going to say, okay, these are my 5 better ones. I'm going to put my cash in there, and I'm just going to let these ones go. I don't think it's a 15, but I think it's probably in 2021, sometime in the second half of the year, where you start seeing some of the filtering through of where can people focus. But I don't think it's coming as soon as I would have thought 6 months ago.
Yeah, I think I all more in Greg's camp. I think the yields that are being targeted by the buyers of distressed assets, if you think about your comment earlier, Bryan, about the risk-free rate, we're talking about 13 to 1500 over LIBOR, right? And then you combine that with how much capital has been raised in the real estate space, both on debt and equity. You just, I kind of scratch my head at the risks you'd have to take today in a major market or even a secondary market to get a 15 on a debt instrument.
Right, and there's capital coming out of Asia that we talk to investors that are happy with a 6, and so if there's capital that's happy with a 6 or 7, that's competition for someone who's trying to get to a 14 or 15.
Yeah, and that was my point. There's that whether it's wealthy families or people in countries with negative interest rates, I think they're going to trump those guys that are trying to get the 15s. I mean, I'm seeing it already in these deals. And if you're trying to sell a note right now, you want to sell it to a family office, because you'll get better terms than if you're trying to go sell it to the institutional guys that raise the closed-ended funds.
And I don't know how the rest of you are, but I would say,
in fact, one of the things we've heard. Sorry,
go for it.
Well, I'm going to go then. One of the things that we've heard from brokers, because we talked to the loan sale brokers, is even if in the example you gave earlier, Greg, you thought the note was worth 95 cents, the buyers of those notes can't buy them at that price, not only because they promised the 12 to 15, whatever, but also because they're still raising capital. And they want to show those first couple that at least can pencil to those higher numbers. Whether or not they come to fruition is a whole other story.
Yeah, that's a great point.
Yeah.
Well, and some of the things, I don't know how the rest of the books are, you guys are managing, but I would just compare where we are today, even our high yielding strategies versus where we were in 2008. There's just a lot more equity in the system. There's just a lot more equity in the system than there was back then. And the growth over the last few years has been fundamental NOI growth in the industry. And so cash flows have been growing, where you look at 2005 to 2008, cash flows were flat and it was just cap rate compression driving everything. So there was just not that much room in the system at that time. So it happened a lot more quickly. We're dealing with stress assets now, but frankly, because of the pickup in cash flow, they probably delevered to 50%. So they've got a lot of equity in there. So they're like, I'm not going to make a decision now. So I think you'll be a little bit more muted than you saw before. The stress is there. It just may not be as overt on trading.
Yeah. Right. I'm going to shift the conversation a little bit just to when you've touched on it, but asset classes. Clearly retail, hotel have been the problem, folks, in a very core way. Industrial, multifamily, better. Office. Office seems to me that could be looking very much like the hotel sector right now, and it's just a matter of time. But it really take a step back, think about what happens, and I'd love just to share your thoughts generically on what happens to office. What's it look like 12, 18 months from now, assuming that we've made progress from a medical perspective and folks can go back to work. I mean, personally, it seems to me that there's probably some sort of change. I don't know if it's a sea change in demand and usage, or if it's a location, CBD versus a suburban issue. It is tough to see, the office market that has held up pretty well so far, continuing to do what it's been doing. Comments on that, and anyone jump ball once again.
Yeah, Lisa, this is Jenney P.
How are you? I didn't know you were with us. That's
okay. I was going to make a joke that maybe my computer was made in Nevada. It's taking forever. But, from the bank side, I can tell you that we're already seeing some of that stress. There are occasions already where what we're seeing is lease contraction. We're not seeing tenants falling out altogether. We're seeing tenants coming back to us and saying, okay, listen, I need less space, clearly, because, I think there's a lot of confidence in remote working environments. But I also think that there's still a need for office space. If you're a bank like we are, you can't have confidential information at your home. You can't print loan documents. There's so much that you can't do, that there is a real need for office space, but potentially not as much, right? So what we're seeing is office tenants are saying, you know what, I'm going to contract my space. I'll kick out my lease term. I'll renew for, another 5 years, but I just need less. So we are starting to see a little bit of that. I don't know that it's enough to call it thematic just yet, but we are starting to see that.
Yeah, no, thank you. That sounds right. Others?
Yeah, we've got a big, we've got a bunch of suburban deals. We're not big urban infill guys. And look, I don't, urban infill will be tough. I don't think it goes away by any stretch of the imagination. If you remember after 9/11, everybody's like, well, nobody's going to ever lease a building over 30 stories. Well, that lasted 9 months, right? So this will be a longer dent. But if you just see like Regus, we have a fair amount of Regus leases, and you saw them BKing the stuff in the urban infill stuff, and the suburban stuff is actually going gangbusters now. So you've seen a little bit of that shift. It's probably not permanent, but it is a little bit of a shift that you're seeing going on right now. And so I do think there is something to that suburban urban a deal. Anything really with a super commute is going to be problematic right now, but we've really seen it in all these Regus leases. And then, if you take in the work share stuff, that's probably a whole nother dynamic. And, look, they were different than the WeWorks. Obviously, Regus was just been around a long time, but we were seeing a little bit in the office. But to her point, you got to work in an office. There's got to be office space. We're being asked by our corporate area, hey, can you give up space to save money? If you listen to a bunch of these earning calls, all the analysts are asking, hey, are you going to save money on your real estate costs? And I think what most people are coming back with is, yeah, we're probably going to have some more flexibility about work from home, but I don't see some of these companies giving up a lot of space because they're going to either need it for people, or they're going to need to spread their people out, right? They can't go for one person for 300 square feet. They're going to go back to one per 5 or whatever.
Right. I mean, it seems odd that you would not have a seat for every employee that normally works in the office situation. So yeah, no, good point. Are there any asset classes that you think about as potentially being permanently changed because of COVID?
Well, maybe I would challenge, just for the sake of making it
Yeah.
more interesting, I would challenge maybe, Lisa, your statement. I think people are going to go not to have dedicated seats.
Really?
I think that'll be becoming more flexible. Yeah, I mean, you think about my role on a normal day. I'm based out of Washington, D.C. I'm probably in the D.C. office 1 day a week. I'm in New York, I'm in Chicago, and I'll be somewhere. But do I need a dedicated office? Probably not really. As long as a day I'm there, I can get somewhere to close my door. And I think that used to be a harder mindset for people. But now that I don't know how everyone's adjusted, I've gotten rid of paper for the most part. Because I can't print, I've learned to deal without it. So I've got my iPad here that I can write on, and you've got adjusted to it. So I think the idea that you need your office fully customized to you, I think that'll go away. Not for everyone, but for those who may travel or maybe, on the production roles where you're out with clients more, I think that'll be a trend that will pick up. And we already do that in our European offices.
Right.
Yeah.
Okay. Any other asset class that you can think of beyond office that could be permanently changed?
Well, retail is definitely going to be permanently changed. I think it's not going to go away by any means, but COVID has definitely accelerated secular trends in the retail sector. We were already seeing a shift to online pre-COVID, and that trend has only accelerated. And many retailers are reporting sales in e-commerce that are up 50%, 100%, 200%, and BOPIS, buy online, pick up in store is. Curbside pickup numbers are off the charts during this time. So, the future of retail is, skewed towards, omni-channel amenability for consumers. And it would seem that, even some of these retailers are becoming effectively fulfillment and distribution centers. So, I think, when we're looking at, retail deals, and we have financed a few, we're looking at sort of essential retailers, but also looking how they're doing during this time. A grocery anchored center with strong sales and low occupancy costs with limited collection issues is something we would consider. And net lease deals, the CVS's, Walgreens, Rite Aids, we're doing deals like that. But I think retail isn't going away. If you look at the retail sales numbers, they're strong. People aren't going on vacation, but they're spending money in their home. Furniture stores were doing pretty bad in most cases pre-COVID, and now they're doing really well.
Yes.
My wife has bought 3 desks for my kids for remote learning. And even Best, if you look at Best Buy, I mean, they've been doing fantastic during this time. Their online sales are, 90% or 95% of where they were pre-COVID, just through online sales with their stores closed. So I think it's, people will have to adapt and change, and those that do will survive and thrive.
It'll be interesting because I generally wholeheartedly agree with Greg's thesis that he was making around office buildings after 9/11, where people make dramatic changes of how their lives, but actually they won't at the end of the day. The change is overstated. One question we think a lot about is these conference center hotels. So where all these massive conferences are, I always think of the massive hotel in San Diego that NBA is always at, that has 1,400 rooms. It's only there for that conference. That's a long time to me before that comes back in a big way. And I wonder if when you start getting technology now, and you start getting our Milken, we're big sponsors of the Milken Institute. That was virtual this year and online. You start changing. Does that industry just really change? And our spend says we're going to send 5 people, not 50 anymore. And I don't know, but I think that market in those conference center hotels may look very different over the next 10 years.
Lisa, yeah. I'm curious for your view on that. I mean, you run a conference center industry.
Yes.
Industry.
We've thought lots about this. We think at the end of the day, we think at the end of the day, and just basically the feedback that we've received from all of our members, that they would much rather be in that conference hotel than doing something virtually. That doesn't mean that I think this event events like at the events where, we're going to have in December on the DC Symposium and the January conference, I think they'll be fine and they're kind of fun. I think that fun, though, doesn't last forever. At the end of the day, we really want folks, and I think what they're telling us what they want is they want to go back to Miami. They want to have meetings face to face with clients. They don't necessarily want to travel all over the country to meet those clients. Best to meet in Miami, have meetings with as many clients that are out there. And I do think so. For that reason, you'll see it. It's just a question of when people will feel comfortable, one, sending your folks to a conference, and we hosting one for all of the same reasons. And it really does question, though, how is that all going to look whenever that is? Is that 12 months from now? Is it 18 months from now? It's really, really difficult to say. And I tell you, we would not want to be the first out of the gate on having that first conference because it's a difficult thing.
Yeah, and I'd add, I don't know about the rest of you guys, but my corporation is getting addicted to the T&E expense being nothing. And I think I think there's going to be a big problem when you go, hey, I want to send the same 20 people to a conference that I used to do, and they're looking going, hey, your business actually did okay without sending those 20 people. Now we're going to send it to 10. Now, I firmly believe you can maintain your business doing Zoom calls and all that, but I don't think you can grow your business. And so I think there'll be a tipping point, but I'm going to tell you, they're addicted to the fact that we're getting business done without blowing up the travel and expense budgets.
Yeah. Sorry, go ahead.
So just to add to that, and the difference between now and 18 months from now is right now, everybody's in the same boat. Our clients are having the same issues. The banks are having the same issues. The lenders, everybody is in the same boat right now. So not traveling and not going to conference, we have all of that in common. There will come a time where that won't be the case. There will come a time where you will have some clients going, some not. And so I think if you look at this from today's viewpoint, yes, it's terrible. But if we think about 12, 18 months from now, what will the behaviors be? And so many of the things that we're talking about right now really depends on the behaviors of people, what they're willing to do, what they're not willing to do. But once our clients are willing to travel and willing to go to conference, if we're not willing to do the same, then that is potentially a missed opportunity at some point.
Right. And I do think it's a matter of degree. I'm not sure you ever see the same numbers. Take whatever the highest year was of our attendance or anybody else's attendance. I'm not sure you'll see that again. But I don't think you're going to see half. Right. I think there'll be 75% of the folks who say, for the same reasons we just heard, that, yeah, we're going to go to this conference. I think you got to be very careful, too, in that the amount of travel. So do you get to go to 4 a year? Probably not. You probably get to pick 2. And that's why you'll see that slight decline in some of these events.
So you probably see the winners and losers. That's probably not surprising, right? So you're going to see CREFC be fine. But I felt as if
good comment.
To the 2019, I felt like it was like, there's like 94 conferences you're getting invited to, and it's too many.
Yeah,
and
exactly.
At some level, I'd rather a consolidation of like, what are the 2 or 3 everyone's going to be at, so I can make those touch points more efficiently than all these other ones that started coming up. And so that may not be a bad thing for the industry, so we can all focus and cut down a little bit.
I agree. Yeah, no, the one thing I want to ask, we only have, I think, about 7 minutes, is on the retail front. So way prior to COVID, retail has been on an unfortunate downward slide. And yet you've seen a lot of these malls that are newer, have focused on experiential, have gotten clobbered right now as a result, right? Because they're either closed or no one's is going. Does that change? Does experiential retail in some of these malls, especially there's been a lot on the East Coast, where you've seen a ton of money put into these assets, are they viable on a go-forward basis once the medical issue has passed? Any thoughts? Anybody?
I've got one right by my house. Now, look, I'm in Georgia, so I think things are a little different as far as perception and where people are worried about things. the outdoor stuff with some of the experiences that are open are just doing gangbusters. Because I can see they report the tax receipts in our municipality, and they're higher than they've ever been. And I think a lot of them are like, people are like, look, it's outside, the weather's nice, I'm not being confined in a little area, and that's what I'm going to want to go to. So who knows? I think Rick just kind of nailed it when he said COVID is just accelerating a lot of changes that were going on in retail, and it's probably everything else is probably being impacted by COVID, where it would have taken 10 years for some of this crappy retail to die. Now it's just going to die right away. And so I think COVID is the changer, but then some things just aren't going to change. I mean, I've got teenagers and they like going to the open air place to do their thing.
Mm-hmm.
You know what, Lisa, and I think it may work, but I don't think as a debt provider on real estate, you're going to get paid enough to take that risk.
Take that risk. Yeah, no, that makes sense. Just one last question on, and then just if you have anything to add, please do. Borrowers dealing in with the current situation and loans on your balance sheet, loans on your books. How are you faring, and how does today feel different than it did, say, 2 months ago? Are you starting to see a balancing off of troubled loans? Are they accelerating? Any thoughts about that? And I know that not all of you play specifically on the servicing side, but just what are you hearing at your shops? And Rick, maybe you want to talk a little bit about CMBS there.
Yeah, I can jump in on the CMBS front. Obviously, the two hardest hit asset classes are the hotel and retail sectors. I think 25% delinquency was the peak for hotels and 18% for retail, and it's a little bit lower now, but it's sort of I think it's basically when a loan goes into forbearance in CMBS. Even though the borrower is not paying or doesn't have to pay for 90 days or however long the forbearance period is, it flips from delinquent to current. So, we started with a wave of relief requests. The servicers had to sort all that mess out. In some cases, they gave forbearance. In some cases, they didn't. The delinquency rate went up to on average across all property types in CMBS to over 10% in 3 months. It took 4 years to get to that level during the Great Financial Crisis. It took until 2012. So everything happened very quick. And the delinquency rate peaked, I think it was July. And then it slowly trickled down. But again, it's being muted by forbearance agreements being entered into and loans flipping from delinquent to current. So I think the real number is actually much higher than that. And the special servicing number, which is 10.3%, something like that, about 200 basis points higher, is probably the real number to focus on at the moment. And, we may be seeing, a number of borrowers handing back the keys, deeds in lieu, in the coming future. I think the vaccine maybe hopefully gives some people light at the end of the tunnel. Maybe we can extend those forbearances a little bit longer if there's wide distribution of a vaccine at some point next year. But it's really tough to say. But office, industrial, multifamily have fared well. Office is obviously a wild card. I think if you have near-term rollover, those deals are tricky because the tenants are going to most likely ask for a lower rent or kick the can with a short-term renewal or downsize their space. But if you have term on the leases, it's probably better because once we get through this, maybe people forget about the work from home experiment and go back to the office. We don't know. So that should be interesting. But yeah.
No, great. Thank you. Any other thoughts there? I know that we could go on for another hour on that particular topic.
Yeah, I mean, maybe just quickly, I feel like for where we sit, I feel like it's too early. I think we're a little bit in that wait and see mode. We've got a few deals that are modified, a few deals we've got our eyes on, but borrowers are waiting because they've got enough equity in the deal to say, okay, what does the new normal look like, and can I survive in the new normal? So we're kind of just having these updated conversations. We're waiting and seeing, and I think you will know a lot more as 2021 unfolds. But right now, I would say we've got eyes on a few things. Nothing I'm losing sleep over, but it could turn depending on how the market goes.
On the regulatory front, TDRs for both the banks and the life companies, how much of a factor has that played in how you look at things on your balance sheet? And I think,
Yeah, I say, Lisa, I can take that one, or at least start with it. So, from a bank's perspective, the CARES Act did afford us some opportunities to be flexible without the burden of TDR treatment. So what we're seeing now, and I'll tell you from a bank's perspective yet again, leading into the pandemic, I think the banks have come from a place of strength. I say that because unlike the Great Recession, what we were able to do right away is provide our clients with payment relief, right? So if their retail tenants couldn't pay, understood, we stepped in right away and said, all right, what do we need? We need 90 days. Let's get our feet up underneath us and figure this out. So the banks really did come from a position of strength. Now, as we lead into restructures, and that's where we are now, particularly in the hospitality space. Now that we lead into restructures, understanding that these hospitality loans, these projects, we've talked a lot about this today. How long before it gets back to normal? You think ground up construction, which is traditionally what the banks finance, we give 3 years to stabilize a hospitality loan. So we watched it destabilize overnight. So I think we are all braced for a 3-year restabilization period, potentially, maybe more, maybe less. Again, it depends on your location. So we're starting to enter into these longer term restructures. And yes, what I do think we need to see is right now we've got a 12/31 cutoff, right? So we're talking about long-term impact from COVID. And so it doesn't stop at 12/31/2020. So the CARES Act, my hope, and hope is not a strategy, of course, but the hope would be that there would be some relief beyond the 12/31, because quite frankly, that's not enough time to identify and properly restructure a lot of these loans, because they're in the retail side. For example, our retail loan portfolio is doing fine. There hasn't been any request for relief, the mortgage payments being made, but that is all dependent on the long-term impacts and whether or not there's a second wave.
right. No, that's great. And I think that's what we're seeing on the advocacy front, try to extend some of these relief regulatory issues, something that we're very much focused on. We know CARES Act ends end of year. To get that extended would be helpful. But anyway, so folks, we're going to get the hook here at any moment. I really appreciate all the great conversation. And Jen, next time we'll see you, I'm sure. But thanks again for everything, everybody. And that concludes our session. Thank you, Sam. All right. Take care, folks.
Thanks, Lisa.
Thank you.